Ladies and gentlemen, good day and welcome to the Cyient DLM Limited conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishna Bodanapu, Non-Executive Chairman, Cyient DLM. Thank you, and over to you, sir.
Thank you. Good evening, ladies and gentlemen. I am Krishna Bodanapu, Non-Executive Chairman, and welcome to the Cyient DLM Limited's earnings call for quarter one of FY25. Present with me on this call are our CEO, Mr. Anthony Montalbano, and our CFO, Mr. Srinivas Kulkarni. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available on our investor website, which has been posted on our website. We've started the year well in Q1 along what we had expected. While there was temporary supply chain challenges and some of the deliverables in Q1 got right-shifted to early part of Q2, this has caused our growth in Q1 to be slightly lower than what we had expected. However, the visibility is very good for Q2, and our team is aiming to deliver strong results. Our execution path is stronger, and we are on course to meet our customer deliverables from the current order book, which is also backed with inventory and raw materials. Aerospace and defense segment continues to be a strong contributor to our growth, while we expect other industrial segments to pick up in the coming months. We've also seen good developments in the pipeline during Q1. I'm glad to see the progress in terms of adding new logos across industry verticals in which we operate. It is a testimony to our delivery and quality performance within our global OEMs that we've been able to add some of the most prestigious names in some of these industries. The traction in the domestic market is also improving, and we are strengthening the pipeline, and we're looking at improving the sales cycle. As you know, the outlook for the EMS industry continues to be very strong, and we are confident of our strong execution on this opportunity. The rest of the year looks very strong along the expected lines. I will now hand over the call to Anthony and Srini to provide updates on the business and financial performance and the outlook for the year. Over to you, Anthony.
Great. Thank you, Krishna. I'll then start with the business overview. So for the quarter, there's some of the key highlights are really the new logo wins that we've had in Q1. We had 4 new logo wins. One was from a global semiconductor company, and which will be providing EMS services. Another is another defense type opportunity where we have a transfer project coming in, which is another new logo, which has very good near-term and long-term growth potential for us. And another one is in the medtech area, focused on diagnostic equipment for a global market, and then another large defense and aerospace company. So, and our pipeline remains, very robust, with large deals at advanced stages as well. So probably the highlight of the quarter is really these 4 key logos, and looking at, the buildup of our client base. We usually work with industry leaders, and there's really not much of an exception here, as we start these relationships. And one key item as well is with one of our longer relationships that we have. We are honored to receive an award from Honeywell at their supplier summit that they held. And this is only one of 3 awards that were given at the summit, which had participation from only their very, very top suppliers. So this is very much an honor, and something that the team has worked over the years to continue to deliver, and will also be indicative of where we look for things to go in this space. From the strategic point of view, some update is we continue to invest in the technology organization. About a quarter or two back, we announced our CTO being appointed, and we've continued to build that organization with talent and leadership and getting involved in more programs that are built to spec in nature. And we've also expanded our manufacturing footprint in Mysore, and we've continued to have very strong growth in that region, and we've secured a new facility nearby to the current one, which gives us much more runway for growth of existing and new incoming programs. And we've also focused on the India market and strengthening our focus there in terms of go-to-market India sales team and the India defense segment. So these are areas that we are focusing now much more actively, which will continue to add to our Western-based clients overall. So last quarter, I gave an update on the industry, at least in the sectors that we play in. We're in air and defense, medical, and industrial. These are the high-value segments that we've been focused on. And some key updates is, again, air and defense continues to be just very strong. The key new logos and wins in that area, which we just discussed, is a key update. We are building ITAR capability as well that will give us expansion into the U.S. defense segment, and then we also look to further strengthen our presence in the India defense segment as well. So there will definitely not be any lack of focus on this sector. This is our core, and will continue to be a prime area for us. Medical and healthcare, this area will continue to grow for us, and we see it becoming, second to A&D, a much bigger share. We did add a new logo this last quarter, which does have good upside potential as these products get into the global markets. And then we've also expanded into other client relationships, leveraging some of our Cyient services business as well. And then we also have very much a focus overall globally on this segment, and there will be some key enablers that will help bring us more scale and momentum there. From the industrial segment, again, we have some key clients that we have one key win in this segment that we think will be a very significant client for us. We think it could be a top 3, top 4 client for us potentially in the coming years. And then we're also just seeing more opportunities in general that come to us in this segment and crossing various relationships that we've had. Some of it is in line with what we're doing from an Industry 4.0 perspective, but also just from a pipeline perspective, we are seeing that those orders are starting to materialize in industrial as well. So let's go to the next slide. So a little bit about our growth strategy. The core part, the core of our business is the pillar of our strategy, right? So strengthening our current core business, driving larger deals, building strategic engagements through these programs with these significant clients is our main strategy on driving growth within our current top client base. We are focusing much more on India defense, And this is an area of investment that we think will create significant potential for us definitely by the midterm, if not the near term as well. And then also, what I discussed on the capability of build-to-spec programs, which we have signed new ones, which are becoming more frequent, especially in some of the larger programs that we are doing now, where customers are coming to us to do the design and engineering end-to-end, which is truly a market differentiator for us, being able to get that done under one Cyient. Our inorganic expansion is very much on track. We've discussed that we do want to add to client proximity, add capabilities closer to some of our clients, and we've highlighted that we were potentially looking at some acquisitions in North America and EMEA, and we are in advanced discussions in this regard, and I hope to have some updates there, but that is progressing per plan as well. In terms of new industries and new geographies, again, this is when we say new industries, new geographies, this is beyond where our core base business is today. So some of the industries that we will also look at that complement the current high value segments are starting to come to surface. So we are seeing some. There are some opportunities in that we're seeing in areas like electric vehicles, some of the infrastructure-related opportunities, some things that we're seeing in energy, for example. So a lot of these can be categorized under industrial, but these are, I think they kind of need to have their own call-out. And so these new sectors are very high-value sectors, which which we see as an extension of the sectors we're in today. And then again, we look to tap into the growing EMS destinations, such as India and other markets where the demand is growing for these services, and we're seeing opportunities there as well. So that's the main business update. I'm going to turn it over to Srinivas, our CFO, to go through some of the finance updates.
Thank you, Anthony. Good evening, ladies and gentlemen. Thank you for joining the call today, and thank you for your interest in Cyient DLM. Our revenue for Q1 of FY25 was 257.9 crores, which is a year-on-year growth of 18.8%. EBITDA at 20 crores was flat year-on-year. Our revenue in Q1 was lower than expected due to some constraints in procuring raw materials from Israel region. This issue is now behind us, and we have the parts that are required to deliver the volume. This lower than expected volume has had an adverse impact on the absorption of fixed costs in Q1, due to which our EBITDA percentage in Q1 is 7.8%. This is a temporary issue, and we are confident of improvement in Q2 when the volumes come back to our expected levels. Despite this, our PAT grew by 97.7% year-on-year to 10.6 crores. Of course, this was also because of the IPO funds that were available to us from Q2 of the previous year. PAT margins were at 4.1%, which is higher by 164 basis points year-on-year. At the end of Q1, our order book stood at 2,126.7 crores, which is lower by 44 crores compared to previous quarter. We expect the order book to increase in the coming quarters as we successfully close some of the orders that we have in the pipeline. We now take a look at a few of the trends with respect to the key operational performance indicators. Our DIO, that is the days inventory outstanding, and DSO, that is the days sales outstanding, and consequently the net working capital all show an adverse trend. This has an effect of the low volume this quarter, as we use the trailing 3 months of revenue to calculate these metrics. Again, this is a temporary phenomenon, and as the metrics, all these metrics will come back to normal, which is roughly 100 days of net working capital by end of June. Aerospace and defense continues to grow significantly for us year on year. We had some softening of demand in the industrial sector, and consequently, this is resulting in the share of A&D being much higher than for us at the moment than compared to other industries. The share of revenue between PCBA, box build, cable remains more in line with some of the earlier quarters, and even the mix of export and domestic business is the same. This is a tabular view of the same P&L which I explained. As you can see, the EBITDA is at 7.8%. This is a drop in percentage terms. In absolute terms, this is flat year on year. And PAT has grown 97.7%, and then the PAT percentage is up by 164 basis points. And the last slide from a finance perspective is the IPO proceeds utilization. We went IPO last year in the same month on the 10th of July. And in the 1 year, we have used roughly 38% of the proceeds. And we still have the money set aside towards inorganic acquisition, general corporate purposes, and the working capital requirements to be used up this year. Yeah. With that, we can start the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Sanidhya Agarwal from Unicorn Assets. Please go ahead.
Hi, am I audible clearly?
Yes, please go ahead.
Yeah. Hi, so first question is on industry-wise segregation. So as you can see that almost 26% comes from aerospace and 57% coming from defense. And also the other EMS players, if we talk about, they are very clear that they have high margins in these two businesses, which is aerospace and defense. How are we not able to get higher margins in these two industries, whereas the other players are getting? That's perfect.
Yeah, so I can go ahead and answer that. So it does come down to the type of programs that you are running. So we have a very specific large program in the defense sector that is runs at a lower margin compared to the rest of our business. And so that is the reason why that sector does show slightly lower margins. The aerospace piece, however, is much higher margin, and that part is continuing. That part will continue to deliver at those margins as well. We also discussed earlier about focus on India defense and also potential U.S. defense, and so these types of opportunities would also yield much higher margins, similar to what we see in aerospace. As compared to the one specific deal that we have in the defense sector today, which is making up a lot of our revenue that we're currently shipping.
Okay, and secondly, on terms of what's the capacity utilization for now, and till when are we thinking to use all of the proceeds from IPO and capacity?
So in terms of capacity utilization, we are roughly at around 55%. And from the IPO fund utilization, I think there is a runway of using the working capital for another 18 months to 24 months. And then, of course, M&A and general corporate purposes is also set towards the M&A will happen as and when the event happens.
Okay. And lastly, on the bill to specs and with respect to margins as well. So initially during the IPO time, the management promised to get near about mid-teens margins and EBITDA margins in terms of getting business through build to spec and other divisions. So within now we are there almost 1 year after the IPO, and I think the management has a visibility for next 1 year. So how are we thinking, till when can we think that build to spec would be a good part of our book and we will be able to get higher margins, like not from 1 year perspective, but from 2, 3, 4, 5 years perspective?
Yeah, that's a very good question, because that is correct. The build to spec programs will deliver higher margins. I think the mid-teens, if our base business is, let's just say, delivering 10, a build to spec program maybe could be delivering 13, 14 percent, or maybe even a little bit more, depending on that specific program. So these programs, right now we've secured these programs and we've started to deliver on them. So as they start to make up a greater percentage of our revenue, then they will start to have more impact on our business. And so for this fiscal year, the build to spec impact from a margin perspective will be negligible, because today build to spec this fiscal year will probably make up less than 5% of our revenue. As you start to look out over the next 2, 3, 4 years, then those programs will start to make up a larger share of the revenue, and then you'll start to see a more positive impact on the margin profile as those bigger programs that are built to spec start to ramp up.
Thank you. And just to follow up on the last part also, from where are we expecting build to spec? Either they are the export clients or the internal Indian client companies?
They would be both, but right now we have them signed with non-Indian companies, so I guess export. That's where the current build to spec programs are signed, but we are looking. This is really part of our core offering. But we have build to spec programs today being delivered on our lines, right? And it's just that these are first runs, second runs, and so as you start to hit into the initial production phases, then you'll see the volume start to go up and have that impact.
Great. Thank you so much. All the best.
Thank you.
Thank you.
We'll take our next question from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. I hope I'm audible.
May I request you to use your handset mode, please, Mr. Krishnan? Not very clear.
Yeah. Is this better now?
Yes, please go ahead.
Yeah. First, I think question to understand the order book, because it's been sort of 8 quarters where we've seen slight decline in order book on a sequential basis, while we've indicated in a lot of logo signings and all of it. So when does that sort of start translating into order book growth, and do we sort of have a guidance as to what is the year-end order info number or order book number that we want to reach to?
As far as giving a specific guidance number, the key element is that there definitely will start to be an increase in order book over time, especially as we start to extend on the existing programs. And a lot of those programs do kick in H2 usually, as far as the POs that are needed for that. So a lot of that just comes into the timing of it. So and Q1 usually is a relatively, I don't want to say cyclical, but usually is a softer quarter if you look at it historically in terms of order book. And then again, the nature of our business with a relatively few number of clients, and we kind of use the term that it can be lumpy in terms of how it's delivered, and this is still similar from an order book perspective as well. So that will eventually catch up, and we still maintain the guidance that we've given on the overall growth for the business, which the order book will of course need to support that.
Sure. And maybe how much of our exposure is indirectly or directly linked to the Boeing supply chain? And second, given the customer advances number relatively being flat, that implies that we're not getting any more orders from the large Indian domestic or defense companies. Is both that understanding correct?
So we do not have much exposure we do not have much exposure as it relates in our current production to Boeing. And then your question, I'm sorry, your second question on the supply chain, can you repeat that again?
No. So essentially, your customer advances days flat at 28%, and I assume that large part of this customer advance is coming from the large BEL, essentially. So that indirectly implies that we're not growing our BEL order book at the current time frame. Is that understanding correct?
Yeah, part of that. So that's a big program that we've been continuing to deliver upon. A lot of the customer advances have been given usually when there's more supply constraints, and so we've seen that there has been less supply constraints overall. Of course, we did have one specific part which caused us some problems this last quarter, but overall, the overall environment from the supply chain aspects and securing and getting advances, we have seen less advances because of more stability in the supply chain. That's what I'd attribute most of that towards.
And last,
Yeah. Sorry, go ahead.
I think from the large India order perspective, yes, there is cyclicality in that order. I think it's a 2-year contract, so the next set of customer advances come only when that gets renewed, right? So till then, you will see the current advance as well as the order being used up. That's only an additional point I want to add.
Sure, sir. And maybe just wanted to sort of look at in terms of new geographical expansion, new vertical, and the inorganic expansion plans. We've been highlighting this for a while. So by when can we sort of see some concrete news flow, either on new categories added or on the M&A being closed?
So we view this as we don't view this as a one-time event, and we do hope in the very near future to be able to announce specifics, right? So basically, when we are able to announce is once a deal is signed. And so, as I've been able to, highlight earlier, is that we are in very advanced stages right now, and as soon as this one specific opportunity is signed, we will be announcing that. And it does align very much with the sectors and geos and strategy content we shared in the deck. And then we're also looking at, other opportunities in other geos as well. And then that'll come a little bit further. But we are very close.
Sure. And maybe just one final question, given the large negative FCF for the quarter. By year-end, do we sort of expect to be FCF positive, and do we sort of have a net working capital days target?
Yeah, maybe I'll answer that. So, look, I think for Q2 definitely we will be positive, right? And then it's a little hard to predict what will happen by the end of the year, but our goal is to at least break even now in the current year, right? And if not, all be positive.
Sure, sir. Those are my questions. I'll get back on you.
Thank you. We have a next question from the line of Vipra Srivastava from Intellect Capital. Please go ahead.
Hi, I'm audible, right?
Yes.
Just a question on this EMS for semiconductor company. So just want to understand that what kind of value add will you be doing? Will it start contributing to our revenue this year, or it's sort of a longer term thing and maybe by next FY it will start contributing to our top line? This semiconductor company EMS service?
Are you referring to the new logo that we highlighted?
Yeah.
Or are you talking about the Cyient? Oh, okay. Referring to the new logo, this is a program that we will start ramping up this fiscal year. and the client has expressed pretty aggressive expansion needs, specifically in India, for their products. And so we anticipate that really over the next couple of years, we see this as being very much a high growth new logo. And again, it has the potential, again, another industry leader, and it has very much potential to be amongst some of our top clients.
Right. So, just as a follow-up, so this is a shorter ramp-up, right? I mean, last year you got Saffron and BAE. So, as you mentioned that it takes a longer time frame for that to ramp up, but the semiconductor deal, since it's not in aerospace and defense, it will have a shorter ramp-up, right? And it will start contributing top line quickly, or is this understanding correct?
Yes, yes and no. So, in practice, what you said is correct, but also it depends where the product is, right? So if you want to deal on a new product that is not on the market yet, then there's a little bit different timeline. So in this case, these are products we already have, and they're now going to be manufactured, with us in India. So it is a much faster ramp in that regard. And then you also are correct that yes, in sectors like industrial, semi-cap equipment, and medical, these sectors do ramp quicker than what you might find in aerospace or defense, just due to the regulatory requirements of those sectors.
Right. Last question. So, even though EBITDA has declined, gross margins have remained flat. So, I mean, how do you see that evolving? I mean, gross margins, since a large part of this year's order revenue will be from exports. So, do we see further improvement from here, or this is a trend which is going to continue forward for the quarter? So, any thoughts on that?
Srinivas, you want to take a shot at that?
Yeah, so the gross margins will improve. So will EBITDA for the rest of the year. What we are in Q1 is lower absorption because of the volume. And as volume picks up, we will see better absorption coming in and seeing an improvement. The other thing that will impact is also the mix of the business, right? As you know, one kind of our business is at a lower margin, and that starts to change with the growth that we see in the rest of the year. So that will be another contribution to the margin.
Right. Last question. So, if Q4, the NWC guidance was 100 days by the management. So, obviously, this is a temporary quarter with 171 days, but do you maintain that guidance, or do you see it slightly difficult to achieve that?
No, we maintain that guidance. Q1 is definitely one of the issues because of lower volume as well, the higher build-up of inventory. We are actively working to correct both those metrics, and we will see a substantial improvement if we do it.
Sure. Thanks. All the best. Thank you.
Thank you. We have our next question from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Yeah, thank you. So firstly, how should we see the industrial segment? This is straight third quarter of YOY degrowth. So how should we see it over a 2 years or 3 years timeline?
So, the industrial segment is a broad segment, right? It covers everything from energy to semiconductor to even some infrastructure services. So we have had one of our key clients in the sector work through some inventory that has built up, maybe some product that we built for them, and they've had some softening. It's been taking them some time to work through that. We have indication that is expected from this one key client to demand to return as they concern through that in H2 of this year. But then there's also the other clients in this sector, some of which are building, and also some new logos as well. So I think most of what you saw as it relates to industrial and our current makeup today, a lot of that is currently being driven by one client burning through, slowly burning through the inventory that we built for them.
So, is it possible for you to mention which industrial sub-segment where you're facing the issue with this particular client?
So I would just say H2, we see forecasts, we've been given a forecast that in H2 that should be improving again. And then again, we see other programs as well that come into this sector that will also complement that.
Okay. And secondly, the increase the SG&A investment. So can you talk about the goal and longevity of this cost and how much is the total quantum for FY25?
That question was not clear. Can you please ask?
I'm repeating.
I want you to use your handset mode, please.
Yeah. So the higher SG&A cost that you alluded to the PPT, so I wanted to understand what is the total quantum for this SG&A investment for FY25 and what kind of goal behind this investment?
So the SG&A was higher in percentage terms, right? Because the revenue was lower, right? Not in absolute terms. Whatever we have as an absolute SG&A spend multiplied by 4 will roughly be the number for the year, more or less. I don't think there is any significant investment that is coming up in the rest of the year. So as the volume improves, we will see better absorption coming through the year.
Understood. Thank you.
Thank you. We have our next question from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity. Sir, I really wanted to understand on this industrial client, I mean, what is the challenge which is going over there? Because, when we see 80% drop in revenue on one side, on the other side, the inventory days going up substantially. So if you can throw some more light, some color as to, what is the challenge over there, and how do you see that getting subsided? And second question, commensurate to that was on the margins. I mean, is there any one-off in the other expenses because that has also gone up? So how should we see the margins from here on? Will the first half on a half-yearly basis, will we be able to compensate the margins on a half-yearly basis for the loss that has happened in first quarter?
Yeah, so I'll take the first part of that question, and then I'll ask Srini to address the margins piece. But as I covered on a prior question, the specifics that I can give, because we have to, we're limited on what we can say regarding, a specific client, is that it's a matter of burning through, using the inventory that this client has, this specific client has built up, right? So in this sector, this was a sector that had a lot of supply chain challenges, especially during COVID, and shortages, and then even post-COVID, a lot was done to make sure that supply was secured, and so a lot of that was acted upon in terms of securing inventory, securing orders, etc. So, basically the current situation is that this client is needing to burn through this inventory before continuing with the placement of additional orders.
Yeah, Mihir, and on the margin, there is no significant one-off this quarter. From a year-on-year perspective, last year we had the RSU coming only from Q2. So from that perspective, this quarter has the RSU costs, which the last year did not have, right? So that is the only thing. But what you see right now in terms of the SG&A spread is more or less at the stable level. There is no substantial change or one-off that we can expect from here till the end of the year. The only thing that will come in is as and when the M&A activity picks up, there will be some one-off costs with respect to the due diligence, bank fee, etc. But that for now we are keeping that out of the market.
Okay, sure. And this specific industrial client, I mean, will we see situation once again getting normalized from second quarter onwards, or should we see that from Q onwards?
I think right now I would just keep it to H2 is what we are. That's the information that we are being provided.
Sure. And just lastly was on the order book. I mean, we were earlier last year, we were looking at a one big order book in 1Q. But however, given the inquiries which were there at that point in time, but however, that has not flown through. So, how should we see order book building up from here on? I understand that these are lumpy businesses, but the visibility beyond a certain stage becomes important. So how should we read order book from here on?
Yeah, as answered earlier, I mean, it really does come down to the orders coming in for the business that we currently have forecasted within our plan and along with the growth that we've highlighted and set expectations with as well. So we expect to see that to start to improve. Again, it is lumpy. I don't have another better term for it, but it should start. We should start to see some progression there as our clients need to place orders for the next phases of their programs, and then of course there's new programs which will have a good impact, and then we'll be able to announce those shortly as well.
Sure, that's it from my side. Thank you.
Thank you. We have a next question from the line of Darshil from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. Hope I'm audible. Yeah. Hi, sir. So just wanted to ask that I think previously we've given the guidance of 30% growth. So we maintain that for FY25, sir?
Just to clarify, we did not
that is
guidance for a year.
Yes.
Yeah. When we said we are confident of a 30% CAGR over a 3-year period. Today, we will not comment for 25 specifically, right?
Oh, okay. Fair enough, sir. So just to get a sense, maybe how much would our H1 revenue be in general because of a seasonality or Q1? How much of revenue have we missed out due to not being able to supply? Could you get some color on that?
If you look at the last 3 years, I think we have been, H1 has been at 40% and H2 has been at 60%, right? And so therefore, again, we will have a very strong Q2. We can't give out a specific number, but whatever we were expecting in Q1, that has spilled over into Q2 in terms of the shortfall, and we will make it up by the end of it.
Okay, fair enough, sir. And so with regards to our margins, we just wanted to ask that because of lower absorption, we will not be able to we saw some dip in margin. But on an overall, on the year-to-year basis for the full year, we'll be able to do 11-12% margins. Is that fair enough, sir, for you?
Again, I will not give a specific guidance. I think our near-term visibility we said was about double digits, which is about 10%, 10 to 11, I would say. And I think any further levers will come after this through the mix of the revenue as well as increased share of B2B business and of course better absorption because of the growth itself.
Okay, fair enough, sir. And just the last question from my end. So the inorganic opportunities that we are seeing, would that be margin accretive or would they, maybe take some time to reach the margins that we are at? So there might be, another temporary shortfall in margins because of absorbing a new business. Any color on that would be grateful.
I mean, we can't, again, speak about that. I think, the assumption is that there is only one target. So it could also vary depending on which target we are talking about. So right now, I'll say our intent is to, sort of acquire companies which will not be diluted, at least at an EBITDA level for us, right? Because of amortization and other things, it could be, diluted at EBIT level. But EBITDA level, we would aspire to get businesses which are very similar to what we have, so that we don't have further headwinds coming from there.
Fair enough, sir. Fair enough. That helps me. So that's it from my side. All the best.
Thank you.
Thank you. We have our next question from the line of Yash, an individual investor. Please go ahead.
Yeah, hi, sir. Thank you for taking my question. Most of my questions are answered, but I have one big question. Possibility that Trump comes in the new election, and we have seen his policies before where he's decided to end wars, etc. So what is the outlook for the industry as a whole as well as Cyient DLM, wherein if the war comes to an end, especially between Russia and Ukraine and possibly later into the other wars, then can it affect the business on an industry level as a whole?
Let me
That's a very difficult.
I think
Go ahead.
I think the business that we're doing is not necessarily tied to any one specific instance, right? If you look at a lot of the business that we're doing for BEL, for example, the ultimate customer is the Indian Navy. That has absolutely no bearing on what happens in the U.S. The second thing is, if you look at if Trump, no Trump, I think one of the key realities is most companies have decided to, or most countries, have decided to rebalance how their defense spend happens. And you're seeing that in India, where there's a lot more indigenization. We're seeing that in a lot of countries in the Middle East, like Saudi Arabia or the UAE, where there's a lot of focus on indigenization. You have companies in Europe, in Europe, that have to spend more according to their NATO commitments on their defense requirements. And in general, President Trump also, assuming he comes back, has always been a proponent for self-defense, which means that if you look at his last presidency, the defense spend actually went up in the U.S. quite a bit. And therefore, purely from that perspective, I wouldn't imagine that a specific instance at this point in time where the world is and where geopolitics are, a specific or a change in presidency in the U.S. will trigger any specific event that will change the spend pattern. So from what our clients are telling us, and not just in the manufacturing business, but also in the engineering business, what our clients are telling us, there is a fundamental change in terms of how countries are looking at defense procurement, defense spend, indigenization, de-risking, and we don't see things changing in any significant time.
Yeah, that's good. And just a follow-up question. This is slightly towards your semiconductor business. Targeting was that I think the parent Cyient has tried to give some idea that they want to venture out heavily into the semiconductor space. So can we expect some business from that side? And if we can, what will be the likely margins on that front?
So I think it's a bit early to comment on that, and that's probably more a relevant conversation within the Cyient call. But our intent is to venture quite heavily. We have a very strong semiconductor business, and we also see some significant growth there. All said and done, all these businesses, the one good thing about all these businesses is they're also quite complementary. And therefore, as that evolves, because a lot of the outcome of the ASIC business will be the input to the DLM business, because that business will produce or will design and source chips. But I think it's perhaps a bit early to comment on the specifics, and we will wait till some of the actions start to materialize.
All right, that's it from me. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, we'll take him as the last question for today. I would now like to hand the conference over to Mr. Krishna Bodanapu for closing comments. Over to you, sir.
Excellent. Thank you very much. So thanks everybody for participating in this call. As I said at the beginning of the call, it's been a good start. Slightly lower than what we'd expected, but I just want to assure everybody that it's just quite a simple sort of right shift of where things have headed. For H1, we're quite confident on meeting what we set out as the budget for H1 internally, which means that we are in a good footing for the rest of the year. As Srini articulated, our visibility was 30% CAGR for the next 3 years, and we're absolutely on track to achieve that. Of course, some of the orders that many of you pointed out are a little bit delayed, but of course, for the short term, we still have an order book that lets us execute, and for the longer term, the pipeline looks better than it has ever had which will translate to some very, very strong orders. I think the pipeline is already in excess of $1 billion, and even weighted, it's almost $500 million. So we are quite confident of building up that pipeline. I don't see that to be a challenge to deliver a 30% CAGR over the next 3 years. So with that, I'll once again thank you for your confidence and support in Cyient DLM, and we will speak again this time next quarter. Thank you.
Thank you. Ladies and gentlemen, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.